We don't know. Okay, let's hope for the best. Okay. Anyway, so that's that. Determinant of beta industry, right? Industry effects. The value of the firm depends on the sensitivity of the demand for its products and services and of its cost to macroeconomic factors that affect the overall market. And cyclical companies have higher betas, as I said before, right? Firms which sell more discretionary products will have higher betas than firms that sells less discretionary products, like diapers, right? And then determinants of betas, right? Operating leverage, right? Operating leverage refers to the proportion of fixed costs out of the total cost. I told you before. Other things remaining equal, the higher operating leverage results in greater earnings variability, which in turn results in higher betas. Detailed information about cost structure is not available to outsiders, so we typically assume that firms in the same industry have the same operating leverage. The thing is, this cost structure information is deep insider information. Okay, that's the last thing that you want to disclose, right? It's like a Coca-Cola's what? Secret recipe to make this cola. Okay, how do you make this so much delicious so that everybody wants to drink it? 며느리도 몰라. You don't even tell your daughter-in-law. That's Korean, right? Korean saying going on, right? The secret you don't want to disclose. So this is why operating leverage, we just take it, lump it into the industry factor there. Still, we can answer the following question based on the operating leverage. Which industry would have higher operating leverage? Auto manufacturing versus closed manufacturing. Of course, auto manufacturing, right? You see the equipments, right? The robots and those machines going on, right? This kind of things. You need high investment, initial investment, and high depreciation going on. Whereas closed manufacturing, well, you need high labors going on, and then more, you can lay off those laborers depending on the business cycle, so that the cost structure will be more variable than fixed. High depreciation versus low depreciation is the issue there. Okay, and then determinants of beta, financial leverage is the next thing. As I said before, as firms borrow, they create fixed costs that make their earnings to equity investors more volatile. This increases earnings volatility, which increases the equity beta. Okay, so stockholders, equity holders, they suffer higher risk when the company borrows more. The beta of equity alone can be written as a function of leveraged beta, levered beta, as a function of unlevered beta and the debt to equity ratio. Okay, using this formula. This formula or equation is called HAMADA equation, right? Beta unlevered should be equal to beta levered, right? Beta levered should be equal to beta unlevered times 1 plus 1 minus tax rate times debt over equity. We will get back to how to derive this equation later on. Just a minute. And here we define this variable beta levered, okay, levered beta or equity beta. Okay, we will, there is a interchangeable usage of terminology, so don't get confused too much. Okay, levered beta or equity beta, we mean the same thing. Okay, and then debt over equity, that is debt to equity ratio. Okay, debt to equity ratio. But it should be what? Should it be book value based or market value based? It should be market value based. Okay, it should be market value based. Why? Because the estimating of this beta, okay, should be something determined in the market. That should reflect the perspective of market investors right now. Why market investors right now? Because we are in the process of getting the required rate of return in the market. If we are taking the perspective of both the CFOs, the CFOs and the market investors. CFO of the company, if he or she goes to the market right now and raise capital in the market, what should be the required rate of return that reflects the perspective of the investors in the market right now. So what matters is the market value right now. So that's why we focus much more on the market value, even in the HAMADA equation over here. Okay, market value. All right. And then I'm going to ask you this question in your exam, by the way. Unlevered or asset beta, okay, is this guy, B beta sub U, okay, beta sub U. Okay, again, the terminology, we will use it loosely, interchangeably, unlevered or asset kind of things, right? Right, okay. And then T stands for tax rate. Tax rate gets back to your accounting 101, okay? You have two different taxes over there. What was there? Well, tax rate, two different tax rates. One is marginal tax rate and the other is effective tax rate, okay? Which one should you use? Well, what is marginal tax rate and what is effective tax rate? Effective tax rate is simply the total tax amount that you paid divided by the profit before tax. Okay, effective tax. How much did you pay, okay, as a tax last year? Okay. Marginal tax rate is what? 한계세율, which means, well, depending on the profit level, profit before tax level, 세전이익 level, your marginal tax rate changes. Okay, for a certain amount, initial X dollar amount, your marginal tax rate is 0, which means for such poor companies, small companies and poor companies, and the government says, you know, poor little thing, don't pay taxes. Okay, you're doing good job of doing business and you are employing a lot of people over there. That's good enough, right? So don't pay tax, right? Up to a certain level, marginal tax rate 0. And after that level, the government starts to say what? Okay, right now you start to pay, you know, doing good business enough, so it's time to pay tax, right? Pay tax, right? And then after a certain level, what? They increase the marginal tax rate and say, you're a rich guy, right? You pay more tax. I want you to pay more tax, right? And the marginal tax rate increases like that, okay? Stepwise increases. And the company at any given point of time, at the point of raising capital, going to raising capital in the market, right? They would stand at a certain profit level, okay? Depending on their situation, they would stand at certain level of profit before tax. And then at this tax level, okay, at this profit level, if they raise capital, what is the tax they have to undergo? What is the tax that they have to assume? Okay? Well, that really comes from marginal tax rate, not the effective tax rate, right? At the moment of raising capital, right, where does this company stand? Okay, in terms of profit before tax, and then that has to be reflected. Okay, so in that sense, the marginal tax rate should be incorporated in this equation. Okay, not effective tax rate. Okay, notice when debt equals to 0. Okay, when debt amount is 0. Okay, what happens? The levered beta should be equal to what? Unlevered beta. Unlevered beta by definition, okay? Unlevered by definition means no leverage, unlevered, okay? Beta that is unlevered. So no debt beta, okay? When the company has no debt, all you have is equity, right? All you have is equity. And that is the situation where your equity beta equals unlevered beta. Very important thing. I'm going to ask you this question later on in your exam as well, right?
HAMADA equation, right? And believe me, right? Um, this one, the equation will be the most fatal to you throughout this semester. Why do I bring Hamada over there, right? The name Hamada is a Japanese one, right? In 1960s or 50s, there was a finance professor called Hamada, and he invented this equation. And the thing is, as it turns out, Hama, okay, in Korean pronunciation is like hippopotamus, and then this hippopotamus is the most dangerous animal in the world in terms of human fatality. If you think lions are the most dangerous animals for human beings, no, not really. Okay, why? For lions, we don't even bother them, right? But Hama or the hippopotamus, we just don't realize the danger of it and then just poke them, yeah, and then get kicked, right? Like this, okay? Um, so many people, get wounded or dies because of Hama or the hippopotamus. One thing I tell you about this Hamada equation, likewise, right? This equation will bother you like crazy, okay, throughout this semester. So why is that the case, by the way? Because it involves a lot of intuition related to corporate financial decisions, capital structure decisions especially. The leverage ratio affects the systematic risk of your company. That is the most important part, right? So that we have to, bother you anyway.
Determinants, right? Earlier we estimated the beta of Disney from a regression. Was beta a levered or unlevered beta? Assuming that Disney has no debt, then it should be unlevered beta. But Disney has debt, then this beta has to be levered beta. Okay, levered or unlevered, purely it really depends on whether you have debt or not. Okay, so that's one thing to tell you. And then deriving, okay, deriving this equation, beta, you remember, it's a weighted average of the betas inside your portfolio. This portfolio can be anything, okay? In the balance sheet of your company, a single company, can it be understood as a portfolio? Yeah, why not? Yeah. If you look at balance sheet identity, asset equals debt plus equity, all right? Then your asset is a weighted average portfolio of debt and equity. Make sense? Yeah. So we can think about the return, okay, investment return to your assets, and which will be the weighted average return of your debt and equity. And then the weight should be market value based weight of debt over asset and equity over asset, like you see over here. Okay. One thing is that some of you accountants, CPA, oh my God, CPA. You guys may think like, where's liabilities, right? Asset should be equal to liabilities plus equity. I know, forget it. We don't think about liabilities over here, strictly speaking. What we care about is debt, interest-bearing debt only. The remaining small part that you know as an accountant, but not important. Forget it. Okay? Deferred tax liabilities or miscellaneous items over there that I know that has to be there. Forget it. Okay? This is not accounting. Okay? What we care about is interest-bearing debt. That's the only one. All right? Why is that the case? Because interest-bearing debt, that is about the debt capital market. And equity, stock, is about stock or equity capital market. What we care about is a capital market. And deferred tax liabilities or asset, this kind of things, has nothing to do with this capital market at all. Okay, it's just an accounting manipulation that you are, making things smooth. Forget it. Okay, focus on what is important. Right, that's what finance is about. Now, beta of an asset, you can think about it based on the returns. Why? Because the return of anything, your asset or liabilities or debt, right? Debt or equities, right? You can think about the investment return for these guys, right? As long as there is an investment return, you can think about their betas, their sensitivity to the market. Okay, so beta of asset, you can conceive it, and then accordingly you can do a beta of debt and beta of equity as well, right? And then the beta of asset should be what? Covariance over variance, and that variance on your denominator has to be the variance of market portfolio's return, right? And then covariance has to be your investment securities return covariance with market portfolio's return, right? And it will look like this in that sense. And then you expand this return like this, weighted average return of your debt and equity. Okay? The right hand side, what's that? Right side of your parentheses, just keep it over there. Don't bother it, right? And then you will expand it. Oh yeah, by the way, yeah, MRD, right? Anyway, so covariance. Okay, what's the random variable? This returns, right? Returns and market return. The kobrang I told you before. This is the random variable you're interested in. The weight is a fixed number. I said before. Once it is fixed at the beginning of the period, it goes until the end, right? So this constant or coefficient, you take it out of the covariance function, right? And then so it becomes like this and that, which gives us to be like this, like that, right? And which will be beta of debt and beta of equity, respectively. So asset beta, we can think about it conceptually. And then equity beta, we already thought about it before. Is this equity beta the beta that we thought about before in security market line or whatever? Yeah, of course. Yeah. And regression beta, yeah, typically those regression betas are regression estimates of this guy. Okay. True equity beta, we don't know. It's a parameter. We cannot observe it, but regression is one way of estimating it. And the idea is the same, exactly the same. And then, if you move on, to the next one. Yes, debt incurs interest expense, which is tax deductible. Okay, so you can think of interest tax shield when you borrow money from the bank. The government always say, encourage business through banking system. Right? As long as you borrow money from the bank and do your business and then you pay interest, well, we recognize it as your expense, okay? So that you pay less tax proportionately. So if the company has a perpetual debt of capital D, right, with an interest rate of small r and a tax rate of small t, and the interest tax shield every year should be the multiplication of these three, DRT, right? Interest tax shield or ITS, okay, is a benefit for the company, and you could consider the present value of this, which would be a part of the asset, okay? Interest tax shield, that is in the credit side of the balance sheet, but interest tax shield, should it be on the debit side of the balance sheet, left-hand side of the balance sheet? Yes, right? Why? Because this is your benefit that you forego paying it, right? ITS is your asset item, should be your asset item, not in accounting sense, right? Not in accounting, but in financial sense, okay? There's no accounting item that says interest tax shield. No. Accounting 101, you learned about it, right? You never learned about ITS before. But in financial sense, we recognize it because this is something that you don't, this is your benefit. This is your benefit for your company. It adds value to your company as much as you are foregoing any tax payment, okay? Because you have debt, right? So this is negative, what's that? Negative expense, okay? Kind of things. Negative expense, minus, minus, plus. Now, every year you have interest tax shield coming in, going into the future, as long as you have debt sitting on your balance sheet. You can conceive, okay, the present value of those benefits, interest tax shields, present value, okay? So the issue becomes, how can we get the present value of all those interest tax shield, okay, that we expect to have in the future, right? Then the question becomes, what should be the relevant cost of capital to discount our interest tax shield, okay? And the idea over here is that the interest tax shield is as risky as your debt, okay? As risky as your debt. Why? Because you have interest tax shield because you have debt in the first place, the most important part, okay? And then this just simplifies those ideas, right? So discount all those interest tax shield at your cost of debt will be the issue, okay? That is the solution. So that is the mathematical formula that you see over here. What do you see? Well, each period you have interest tax shield that you expect to have, and then you discount it at the cost of debt, not equity. Okay, I'm going to ask you this question in your exam. Okay, cost of debt. Why is that the case? Because it is as risky as your debt. That's it. Okay, and then you discount it over what? Throughout your life of your company. Remember, we assume a perpetual debt. Okay, going forever. It's gonna be there, right? Perpetual debt, is that possible? Yeah, 두산중공업 had once, issued this kind of debt, and then British government has a console, which is like a treasury 국고책 kind of things, in that has no maturity, just going forever. Okay, this kind of debt is there. Okay, and then the thing is, if you do the math, you will realize it becomes like DT. Okay, remember this has to sit in your debit side of your balance sheet, left-hand side of your balance sheet. This is together with the asset. It's a kind of asset, okay? You can perceive it. Yeah, right. The next, right? Derivation of Hamada equation just once in your lifetime, okay? Right, so you can think about balance sheet in terms of financial analysis, right? On your left-hand side or debit side of your balance sheet, you will have assets. On the credit side, right-hand side of your balance sheet, you will have debt and equity. Okay. Now, when you don't have any debt, okay, when you don't have any debt, what happens? Well, all you have on your right-hand side will be your equity, and then all you have on your left-hand side will be unlevered asset. Okay, asset equals equity when you have no debt. Okay. Oh, what about that small item, miscellaneous items of like deferred tax liabilities and then things like that? No, forget it. I told you, zero. Okay. We are focusing on the financial part of it. Okay, the what you have, and then how did you finance those things, right? What you have as an operations side, that has to be your asset. How did you finance this thing? How did you raise your capital? Okay, should be on your right-hand side of your balance sheet. Okay, deferred tax liabilities has nothing to do with this kind of things, right? Forget it. How about accounts payable? That thing, we're going to lump it into something called working capital later on. And that working capital, essentially, it's kind of related to inventories. So it's not going to sit on this debt side at all. Okay, we will learn about it later. So don't worry about it. Only the financing side has to be on your right-hand side of your balance sheet. So no debt, only equity. Unlevered asset means just equity, right? Because you have no debt. Okay. That's that. Now you start to have debt. Okay, you start to have debt, which is in this case perpetual debt, for the sake of simplicity in our argument, right? Good. Now I told you before that you have to consider the interest tax shield that comes every year, forever, and then the discounted value of it should be DT, right? DT, and then by that you're going to have two things on your left-hand side of your balance sheet, which is your unlevered asset, okay, and the other is the present value of interest tax shield, okay. Unlevered asset, right? That unlevered asset should, would it be the same as equity value? Would it be identical? Not really. Why? It was the same, right? These two were the same when there was no debt, okay? But now we have debt. Now we have debt, okay? And then together with this debt, you increase your scale of your company. You invest it somewhere in the factory or something like that, right? You didn't do any, you didn't stay idle with this borrowed money, okay? Typically, you do your business, and then the operational side of your business will increase with your debt. So naturally, this unlevered asset by now will be different from your equity value, okay, as you borrow more. So this guy will change. And then the thing is, this unlevered asset should be the value of your asset purely related to your operational side of your business, doing day-to-day business. And then interest tax shield will be the value coming from debt financing, okay? Interest tax benefit. That's the added value, okay? What is the value that is not added but just is sitting on there together? That goes into unlevered asset. You don't have to worry about it at this stage right now. But so that's that, okay? Now, what am I trying to say here? I'm trying to derive HAMADA equation, okay? The thing is, the beta should be, beta of a portfolio should be the weighted average betas of the component asset. So left-hand side, you have a portfolio of unlevered asset and interest tax benefit, interest tax shield. And the right-hand side, you also have a portfolio of debt and equity, right? So for right-hand side and left-hand side, you can conceive weighted average betas, right? And they have to be equal, by the way, because of the balance sheet identity, right? And then this one, I would say total asset, okay? Total asset, we can conceive, burping. I'm sorry, excuse me. Beta of total asset, we can think about it, right? This has to be the weighted average of unlevered beta, okay, beta of unlevered asset, right? And then beta of interest tax shield, okay, beta of interest tax shield. How come you call it beta of debt? Because it is as risky as what? Is as risky as debt, okay? So the beta of interest tax shield will be the same as beta of debt. Make sense? And that's left-hand side of the balance sheet in that story, okay? How about the right-hand side? Well, you have beta of debt and beta of equity, all right? And the weight has to be there, right? I'm going to talk about it a little later. But anyway, the important thing is beta of total asset can be expressed in two different ways, and they have to be the same thing. One and the other. Make sense? Right. Now, you set it equal, and then you will solve for beta of equity later on. But before that, let's think about the weight of each component. Okay, on the left-hand side of your balance sheet. Oh, Let's start with the easier part, the right-hand side of your balance sheet. Debt and equity. Yeah, market value of debt and market value of equity, as long as you have it, you can easily compute the weight of each like this. Good? Fine. Left-hand side of the balance sheet is kind of a magic here. The denominator, 분모, has to be debt plus equity. Make sense? Because we have the identity. These two have to be equal, right? So debt plus equity has to be here. Numerator is kind of interesting over here. Interesting because the weight of interest tax shield has to be this guy, dt, over debt plus equity. Now, what about the weight of unlevered asset? Well, subtract the value of interest tax shield from the total amount. Okay? So it is like 1 minus dt over d plus e. Make sense? Now, oh my god, that seems to be so ugly. But this is life. We have to, explore until we face the real trouble. But let's just go. Okay? So what do we do? The thing is, let's assume beta debt equals 0. Okay, beta of debt equals 0. Why is that the case? First of all, debt market, right? Debt is protected by law. Okay, protected by law. So it is very, how do you say, safe. Okay, and then less risky. If you actually measure or estimate the beta of debt or bond, this kind of debt securities, their beta will be like 0.3 or 0.2 or even 0.1 or something like that. Corporate debt, corporate bond, right? They're protected by law. When it is bankrupt, then the equity holders, they have to stay frozen. The debt holders get repaid first, okay, as much as they can get, okay, legally protected. And then if it is safe asset like AAA companies, its risk rating will be almost similar to the government or something. Very, very safe. So we assume it to be 0 for the sake of simplicity in this calculation. All right. So let's assume it to be 0. That eliminates this ugly term, right? You kill these two terms, and then the remaining part is this guy and that guy. And then we have, what's that? That's this second equation. We cross out the common guys, right? And then we send the equity to the other side of the equation by dividing both sides by equity, right? So beta of equity should be nothing but beta of unlevered asset times this ugly term, debt over equity times 1 minus tax rate plus 1, this equity 1. So that's this Hamada equation. All right. So this is how we derive Hamada equation, and right. Once we have regression beta or levered beta, we can figure out the unlevered beta by using Hamada equation. For many firms, like typically they have some positive amount of debt on their balance sheet, right? So the thing is, as long as the company has some debt, okay, you cannot directly estimate the unlevered beta with regression. All you can estimate with this regression estimation, right, is equity beta. This equity beta, right, if there's no debt, this equity beta will be your unlevered beta. But as long as the company has some debt, the equity beta will be different from unlevered beta. Unlevered beta, in that case, you don't observe it, or you don't have any estimation at all. The only thing that you can do is use Hamada equation and solve for this unlevered beta. All right? Right. Conversely, once we have an estimate of unlevered beta, we can figure out the levered beta as long as we know the leverage ratio. That's what we call bottom-up beta. Okay, bottom-up beta. Now, all right. So the Hamada equation again, right? Over here. And before we move on further, let's look at the equation closer, right? Closer, right? As I said before, this debt amount, when there is no debt, right? When there is no debt, this whole ugly term disappears, right? And that is the moment when your unlevered beta equals your equity beta. Make sense? And then, number two, as long as you have debt, right? Your equity beta will be what? Bigger than your unlevered beta. Make sense? Because this is 1 plus something positive. Can this guy be negative? The answer is no, right? This guy will always be positive. I should write it better. This guy will always be something greater than 0, right? So this guy will be something greater than 1. So that once you multiply this, then it will be bigger than unlevered beta. Equity beta will be bigger than unlevered beta because you are multiplying unlevered beta with something greater than 1. Make sense? So what does that tell us? Okay, as you borrow more and more and more and more, this guy will grow bigger and bigger and bigger and bigger than the unlevered beta. Make sense? This is how your capital structure affects your risk of your equity. Okay, risk of your equity. High levered companies, higher equity beta. Okay, high levered companies again, more volatility in their earnings. And naturally, your beta of equity will be bigger. All right, and that is related to the systematic risk. Okay, systematic risk shows up in the beta. Right, good. How about tax rate? Well, it is negatively correlated. Okay, so more tax rate increases, then how do you say, the gap between equity beta and the equity beta and unlevered beta will shrink down as the tax rate increases. Why is that the case? Because the government gives you some benefit called interest tax shield, right? 손금산입 kind of things in 세법 or tax law, right? Oh, you poor little thing, don't worry. You paid interest to the bankers, you know. We like it. Don't pay tax as much. Okay, that's the idea. So learned about bottom of beta. Let's try it, right? Well, here's one example, right? Let's assume you have some unlevered beta of this industry, okay? Some certain industry. Here in this example, you have Embraer. What is that? That's a Brazilian aerospace company. You can think about it as the Boeing of Brazil. By the way, talking about Boeing, this company is in serious trouble right now. You know that, right? Why? Because nobody wants to, nobody can go to the airplane travel these days, right? No airline traveling, and the airline industry say no demand, so we are not going to buy from you, Boeing. And before that, Boeing had another trouble coming from the 737 the product defect or something like that. So that was a trouble there, okay? I don't know how things are going on with this Embraer as a competitors, right? The 737 Boeing issue must be a good news for Embraer because their customers will be, asking instead, right? But they're hit together, 쳐맞아 together by this virus, right? So they may also face serious trouble. The Brazilian president, by the way, I forgot his name, but he's kind of too much overconfident about this virus issues, right? all the ridiculous things he's talking about these days, it just doesn't make any sense. And the more overconfident these leaders are, the more widespread it becomes, the viruses in that country. So watch out, Brazilians. I mean, I'm sorry about it. You're president, but that's that. Now, Embraer, getting back to this, right? Let's assume you have a good information about unlevered beta of this industry, okay? Aerospace industry. How do we obtain this unlevered beta? Well, you can obtain this unlevered beta by working out from Boeing and some other like Lockheed Martin or its industry competitors, right? You can obtain their regression beta and then using HAMADA equation, and then you can solve for their unlevered betas and then take the average of it or median of it that is representative of the riskiness of aerospace industries. So now let's say that unlevered beta turned out to be 0.95. Okay, 0.95, and then debt to equity ratio of Embraer. You got it from the balance sheet, or not the balance sheet. I'm sorry, it has to be market value based debt to equity ratio. Equity value, well, that's market cap, 시총. And then how about debt value? Typically, we assume the book value of debt to be market value of debt because the market value of debt itself is unobservable. Okay, market value of equity is observable because we have the price information day by day, second by second. But the debt value, we don't have it. Okay, there's no open market for bank debt. Okay, especially for Brazilian setting, right? So the easier way we choose is let's assume book value of debt is equal to market value of debt, and there you obtain the debt to equity ratio, in this case 18.95%. So using these information, and then let's assume the marginal tax rate of Brazil is 34%. Okay, so one more information there, and then together with this you can obtain the levered beta, okay, using HAMADA equation like this. Okay, and then it turns out it is 1.07, right? Embraer, can we go to that company somehow? Samba, Embraer. All right, you can click on it and then see their company, how they are doing. Okay, take some time, and then anyway, small airplanes and mid-sized airplanes, you're going to elaborate on combat to COVID-19. Right, this kind of airplanes, right? Private jets, and wow, navies, or whatever. And then this kind of airplanes, they say, fly over Brazil's incredible landscapes with smoke, squadron. Yes, like this kind of airplanes they produce. Yeah, I mean, Brazil is completely the other side of the globe from Korea's perspective. So it's kind of interesting to see, what's going on from the other side of the world, right? Completely other side of the world. And actually, having said that, it's kind of understandable that Brazilian president have no idea about the Asia originated coronavirus over there. China was the place where the Wuhan was the place where the virus originated, right? So they have less of an information, Brazilians, right? So that's why they may not take it very seriously, but that's not good for your, public health over there. Okay. Yeah. Anyway, so that's that. Now we move down. Why bottom-up betas, right? Because the standard error in a bottom-up beta will be significantly lower than the standard error in a single regression beta. Roughly speaking, the standard error of a bottom-up beta estimate can be written as follows. Well, it will be average standard error across betas divided by the square root of number of firms in the sample. Okay, so it depends on the number of companies in your sample to construct the unlevered beta. As I said before, right? Embraer's unlevered beta, we just assumed it, but I told you it comes from the industry competitors, right? Boeing, Airbus, or Lockheed Martin, or Northrop Grumman, or whatever the aerospace companies that you come up with, right? Those sample size matters here. The more number of observations you got, the more precision you got, okay, in terms of this unlevered beta. The more precision means lower standard error, by the way. And then the bottom-up beta can be adjusted to reflect the changes in the firm's business mix and the financial leverage. Regression betas reflect the past only. So regression beta will be more like a rear view mirror, whereas the bottom-up beta is more supposed to be forward-looking. Okay, let's say Embraer, right? Oh no. Let's say Hyundai Motors, okay, all of a sudden decide to desert motor business, but decides to go into aerospace business, right? Motor business beta, regression beta, or his Hyundai Motors regression beta will be useless in that sense. If Hyundai Motor decides to go into totally new industry, in there, this Embraer's unlevered beta will be much more helpful, okay? And then it would be more informative to understand what's going to happen to Hyundai Motors. Hyundai, should I say Motors still? I don't know. The reason I may still call it Hyundai Motors is because Hyundai Motors in CES 2020, right? They were presenting what? Flying cars, okay? Isn't it aerospace area over there? Flying cars with the helicopter kind of looking car, right? So it's no kidding, right? It's no kidding. The bottom-up beta can be adjusted to reflect changes in the firm's business mix and financial leverage. Regression betas reflect the past. Another story that I have to tell you is that what if your company had no debt before, but from now on you're going to have a huge amount of debt, let's say 2 times the market value of equity, right? The debt over equity will be like a 2, right? Previously 0. Your regression beta will be helpless and hopeless because it was based on no debt situation. Okay, it's just giving you unlevered beta, that's it. But from now on, your beta going into the future, it has to be something bigger, reflecting the 2 times leverage, right? So drastic change in capital structure will affect your beta drastically. In there, regression beta will be useless. Your bottom-up beta will be very useful. So that's the idea. You can estimate bottom-up betas even when you do not have historical stock prices. Okay, so this is very handy, or this is very useful for private equity companies or venture capitalist companies, right? Because you don't have, for your private companies that you own, no regression beta available in the first place, but you can always compute this bottom-up beta, right? So that's that. Determinant of betas, right? 2 approaches in unlevered and leveraging beta. Approach 1, obtain the average unlevered beta of your industry, right? By working with the average equity beta, average tax rate, and average leverage ratio of the industry. And then compute the levered beta by using your company's leverage ratio and tax rate, using the average unlevered betas in step 1 as your firm's unlevered beta. Approach 2 is obtain the unlevered beta. Obtain the unlevered beta for the companies in the industry. Obtain the average unlevered beta and compute the levered beta by using your company's leverage ratio and tax rate using the average unlevered beta in your step 2. So 2 different approaches are there, and 2 different approaches will give you different levered beta. Okay, different answers, different approaches. Okay, in the exam setting, wow, how would you grade it? Two different answers, and I only give you one answer to you, Andy. Would you cross me out? No, don't worry. I have two different versions of answers for you as well, so you don't have to worry about it. And bottom-up beta approach, right? Bottom-up beta approach here is an example company called Van Shoes. I'm gonna disappear for a while. Let's see over here. Yes, Van Shoes is a shoe manufacturing company, and that is not publicly traded. Its target debt to equity ratio is 9.41%. Again, that's market value based. And then tax rate is 34%. Estimate its equity beta using the betas of all publicly traded shoe companies in the Excel file over here, as you see on the table. All right. Now, before we move on further, let me be clear about this. Why did I say estimate its beta instead of precisely compute or anything like? Of course, we are doing precisely computing it, trying it, but estimate, right, gives you this word gives you the idea that we are, estimating something unobservable. True beta, true equity beta, that's something we cannot observe. Okay, we are just estimating with some errors, and then with some errors, well, we use a sample of competitors, right? So what you see on this table are a whole bunch of competitors in that shoes industries, right? Let's go. Barry brown shoes, I think. Candies, and then the Deckers, and the K-Swiss, Lacrosse, and Nike, of course. Reebok, yeah, of course. And all these things. Timberland, yeah. Those guys are over here. And then their equity beta, you can estimate this equity beta. How? As long as these companies are publicly traded in the stock market, you can estimate those beta using regression approach. That characteristic line, you remember that, right? Yeah. Company by company, you obtain these betas, right? Oh, that's so tedious and time consuming. Well, this is our life, right? You have to be able to do it. And this is why if you master those Pythons and then these kind of codings, things will get a lot simpler and easier. And this is where the robo-advisor can outperform human analyst, right? They will be like, just calculate all these, estimate these betas in a second, right? For thousands of them. Okay, estimate equity beta based on their stock performance. And then market value based debt to equity ratio, you can obtain it. Here, one assumption that I told you before is what? The market value of debt is not observable typically, so let's take the book value of debt as it is, as a market value of debt. Assume this book value as equal to market value of debt. Okay? And then the market value of equity is nothing but the market cap, the 시총 thing, right? So you can obtain those ratios. And then marginal tax rate should be on your next column, right? Second last column, right? Marginal tax rate. It should depend on the company's profit before tax. And look at the marginal tax rate schedule from the government, right? Certain $1 billion range or below, and you have 0%, less profitable ones, I guess. The loss-making companies, right? They, have 0% tax rate, right? So that's why. And then marginal tax rate may differ for different companies with different levels of profit before tax. Just to use that, and then by that you can obtain these companies beta one by one, asset beta one by one, asset beta And then you may say, some of you may say, wait a minute, we did not learn about asset beta. Well, we learned about it. Come on. Unlevered beta. Unlevered beta. Okay? Using Hamada equation, beta U, right? That's this guy. Oh, Andy, that's so confusing. Beta U, beta asset, is that the same thing? I told you before, we're loosely, okay, interchangeably using these two words, okay? So don't get confused, okay? Life is supposed to be simple, and then finance life is too simple, up to the level of really boring. So to make you awake, we try to alternate this terminology, this and that, this and that. Unlevered beta, asset beta, we mean the same thing, just to scare you off in your job interviews anyway. Job interviews, yes. And you don't have to be scared over there. You have to be like, yeah, asset beta means unlevered beta, yeah. So that's the thing we want, right, in finance industry. Do you have that gut to say that, right? Now, that's that. Now, approach 1 and 2 are here, okay? The first approach, how do we do it? Well, for this purpose, we need the end goal. End goal is get the equity beta using Hamada equation, and for that purpose, you need some asset beta or unlevered beta of this shoe industry, reflecting the riskiness of this shoe industry. Okay, and then for this purpose, you need the tax rate information and then debt to equity ratio information about your company. Okay, your very company, Van Shoes. But for this purpose, you first have to obtain this unlevered beta or asset beta. How do we obtain this asset beta? Well, the first step over here, right? Here in the first step, how do we do it? Well, start with your industry peers' average equity beta. That's this guy. Remember, you calculate or estimated all these equity beta using regressions, and then you can simply take the average of it. Yeah, that's this guy, okay? And then using Hamada equation to one direction, so what do you do? Well, divide your equity beta by 1 plus something positive over here. That's 1 minus tax rate times debt over equity. And here, the tax rate that you use is average marginal tax rate that you found in your sample. Okay, so the average of this marginal tax rate should be the representative marginal tax rate of your shoes industries. Okay, so that's what's going on over here. How about the debt to equity ratio? The same idea. Representative debt to equity ratio in this industry is this guy. And this was the representative equity beta before in this industry, right? So using these three pieces of information, you can compute the unlevered beta, which will be 0.51. Makes sense? And let's use this as Van Shoes unlevered beta or asset beta, and times 1 plus this ugly term that you need to get it from your company's information. Your company debt to equity ratio will be 9.44%, right? And then tax rate 34% over there, right? So that's why we have this, and then we compute it to be 0.54, right? And you may say, oh, that's not much different from unlevered beta of 0.51. No wonder. Yeah, that is supposed to be like this. Because why? Because we have such a low level of debt in the first place, right? No debt. Well, unlevered beta should be equal to your equity beta. You have small amount of debt. Your equity beta will be slightly bigger than your unlevered beta. Make sense? Right. That's the first approach. Now the second approach, okay, How do we get this one? Well, the second stage is the same thing. Okay, second stage is the same thing. In the end, you're getting levered beta or equity beta. They are the same thing, right? Equity beta of van shoes using unlevered beta and tax rate information and debt to equity information of van shoes. But the thing is how to obtain this unlevered beta or asset beta, right? Now, this one, okay? In the second approach, oh my God, ding! Without any calculation over here, 0.6 was just thrown in. Bong! No, come on. This one, okay, is coming from this guy over here. For this part, what we had to do is company by company. We had to estimate or compute. We had to compute asset beta or unlevered beta company by company using HAMADA equation, right? I should state it over here just to clarify to you. Beta U, right? Asset beta, okay? Company by company, you computed all these things, and let's take the average and then take it as a representative unlevered beta for shoes industries. Now let's put it in the second stage and then get the equity beta. Make sense? So that's what's going on in the second part approach. Now you see that this beta equity, right? Beta equity coming from two different approaches have two different values, right? Oh my God, I'm in trouble. Trouble everywhere, right? We are living with that, right? And there's a choice that you can make, right? You can pick whatever you want, right? But which one you pick will give you different valuation numbers estimate later on. I told you before, depending on your incentive, your valuation will be biased, right? So the choice of higher number in beta over here, okay, will give you lower estimate of value because higher beta will give you a higher required rate of return. Discount rate being bigger means that the value estimate being lower. So this will give you some good idea about the lower bound of valuation estimate. On the other hand, if you choose lower beta value over here, what will be the consequence upon your value estimate? It will be higher. Why? Because again, lower beta estimate will result in lower required rate of return in your valuation, and this smaller discount rate implies that you will get higher value estimate. So using these two numbers, you may end up with lower bound and higher upper bound, okay, kind of valuation estimates, right? So your true value, you may say you will be somewhere between these two low and high values, okay? No trouble. In the end, it's going to help you, right? So, and the only concern is, oh, I'm too lazy to do both valuation numbers. Come on, right? This is why you get paid. All right. Bottom-up beta approach, right? Single division firms, right? Life is easy. One single bottom-up beta or equity beta will take care of the rest, right? Just like what we did, right? Multiple division, okay, will be something different a little later. Okay, determinant of beta, 3 effects of leverage on betas, Disney. The regression beta for Disney is 1.18, and this beta is a levered beta because it is based on stock prices which reflect financial leverage, okay? And the financial leverage implicit in the beta estimate is the average market debt equity ratio during the period of regression. Average, which means like average average debt to equity ratio of Disney itself. What do you mean? Debt to equity ratio, isn't it just one number? No, not really. Because why? The market cap changes day by day, which means your debt over market cap, okay, debt over market value equity changes over time. And you can think about it, think about debt to equity. Strictly speaking, it has to be the average of it, right? So the average debt to equity ratio during this period was 19.44. Okay, in your valuation exercise, in your homework or your project, I-Core, do you have to calculate the average debt to equity ratio throughout the sample period? Nah, no, I'm not going to ask you over there, right? Don't worry, right? The unlevered beta for Disney can then be estimated using a marginal tax rate of 36.1%. Now, Hamada equation again, right? Based on your current beta, that's your equity beta that we mean, right? 개떡같이 말해도 찰떡같이 알아듣는, like whatever I say it, you get the sense of it, right? Current beta, we mean equity beta that you estimate using regression, 1.18, okay? And to get the unlevered beta, well, divide this guy by something bigger than 1 because you're getting at industry reflecting beta, unlevered beta. 1 plus 1 minus tax rate times debt to equity ratio of 19.44%. So that gives you 1.049 of unlevered beta. Good. Determinant, right? Beta and financial leverage ratio. What I'm trying to say is that as you increase your debt, okay, other things being equal, other things such as your operational side of your business, your day-to-day job does not change. But the only thing that you play with here is debt to equity ratio. Okay, how to finance your business. Would you go no debt or would you go 90% debt and 10% equity, right? That debt to equity ratio, right? Depending on that, your beta will swing or change a lot, right? As we increase the debt, you see the beta starts from 1.11 and increases all the way up to 7.51, which is crazy. So the effect of leverage upon beta is huge, okay? I'm not going to ask you about quantifying this effect of leverage itself. No need to worry about this part, okay? But this part, right? Swinging or changing, that's very impressive, by the way. Other things being equal. Anyway, example, Disney continued, right? Does this unlevered beta reflect the operational risk of Disney? You realize that Disney has business exposure in 4 different industries, right? Previously, we just had one beta, one unlevered beta, but from now on, we're going to worry about the multi-division nature of this Disney and then come up with a bottom-up beta, okay, reflecting the riskiness of 4 different divisions, right? 4 different industries. So, is there any better way to estimate the unlevered beta in Disney? Okay, in the end, we're going to go through weighted average beta concept, okay? And then also on the way, we have to worry about the effect of cash. I told you before, cash is risk-free. Cash is cash, which is just risk-free, okay? Why? Because the companies typically park or put their excess cash, right, on their balance sheet, put their cash into the bank account, which gives them some interest, okay, that is close to treasury rate returns, right, risk-free returns. And so the more cash you have, the safer your company is, right? So the safety net, cash will work as a safety net for your company. The beta of a portfolio is always the market value weighted average of the betas of the components in that portfolio. Thus, the beta of a mutual fund, the beta of a mutual fund is the weighted average of the betas of the stocks and the other investments in that portfolio. If you are concerned about the beta of certain mutual fund in your life later on, if a company has a substantial amount of cash in the balance sheet, in addition to its operating assets, the unlevered beta would be, or asset beta, okay, would be the weighted average of the betas of cash and the betas of operating assets. Okay, the beta of a firm after a merger is the market value weighted average of the betas of the companies involved in that merger, right? Now, cash included unlevered beta and business betas, right? The cash included unlevered beta of a company is the weighted average of cash excluded unlevered betas and the beta of cash. Okay, what? That sounds confusing. Things will get clearer as we move down to the next slide. All right, Disney. Okay, in the previous example, the levered beta for Disney was 1.18. The average debt to equity ratio during this period was 19.44%. The unlevered beta for Disney can then be estimated using a marginal tax rate of 36.1%, where 1.049. That was the answer that we got before, a couple of slides before. And you realize that the Disney has significant amount of cash and its market value based weight is 0.1. Okay, 10% of the asset is cash. Wow, cash rich. You can create a bank. Yeah. Whereas the market value based weight of operating asset is 90%. What is the cash excluded unlevered beta in this case? So, before we talk about multi-division approaches, let's first think about cash weighted. Okay, cash weighted unlevered beta. Okay, cash weighted asset beta. Right. Right. Embraer, right? Anyway, so before we move on further, right? So unlevered beta, how would that be? Well, for this purpose, how would you calculate it? You realize that the significant amount of cash, right? 10% of it is cash. Okay. The thing is, this is the asset beta. Okay. Asset beta, total asset. Okay, which is this guy, the left-hand side of the balance sheet. Okay, and then debt over equity. Okay, so this is 1.0449. Okay, and then later you realize that, oh, this, out of this, 10% of this asset is cash. Cash, beta of cash has to be 0. Okay, and then the remaining part, which color should I use? Remaining part, is it distinguishable? No. The remaining part, which is this part, okay, should be the operational side. Okay, should be the true or pure operating asset, right? Now, what you got, 1.049, okay? This asset beta is a beta of the whole thing, remember? Yeah, you have the whole thing, those assets. And then you want to get to the unlevered beta that reflects the true risk of this operational side of the business, excluding the safety net effect of the cash, right? And then that means the true asset beta, excluding the cash, will be higher than this guy, somewhat higher than this guy. So 1.049 should be the weight of cash times beta of cash plus 1 minus weight of cash times beta of unlevered asset true. excluding cash, excluding cash, x cash, right? Our task is to get this one, right? Our task is to get this one. Based on this beta unlevered total asset, including cash, I say it, including cash. From here to there, how do we go there? Well, the thing is, let's use other color over here. This guy, cash beta, okay? How big is it? What is this cash beta? Oh, Andy, you didn't tell me the cash beta. Of course, I didn't tell you, but you can. Imagine it, okay? Use your imagination. What should be the beta of cash? That should be what? 0. 0. Why? Why is the cash beta 0? Because this is the safest asset. Make sense? It's typically US Treasury that you just put your money over there. Okay? Bank account, bank deposit, that kind of things. Very safe asset. Beta 0. So you can safely cancel this guy out, right? Good. Now what's remaining will be this guy. And then another information that you got is that weight of cash, this guy is 10%, which means this guy is 90%. 0.9, right? And the only unknown is this guy. So 0.9, send this guy to the other side of the equation by dividing both sides by 0.9. Make sense? So you get what? 1.049 over here, okay, divided by 0.9, something less than 1, so that you will increase the beta result, right? So so let me expand this. Hello, over here equals this guy, 1.16 1.166, right? That should be the unlevered beta excluding cash, right? Excluding cash. Intuitively, this unlevered beta is higher than the unlevered beta with cash, because cash is your safety net. Okay. Now, by the way, how do you set this calculator to give you the right digit numbers? For example, some of you may wonder, as you turn on your calculator, mine gives you 5 digits below decimal point, right? 소수점 이하 5째짜리까지, right? How do we set it that way? Well, you have format over here, format that you see over here. For this part, you need a shift key. The second, the yellow part over here, the yellow one. All right, and then format, and it says DEC, right? Decimal digits below decimal point. I put it as 5, okay, which is 5. I punched in. What if I punch in 2? It will become 2. Where's that? 2. Okay, 2. And then input, is there input? Enter, yes, enter, right? Enter key, ba. All right, and then, oh, come on. If I say again, second, and then format, and then 2, right? 2, yes, 2, and then enter, enter. It automatically gives you 2.00, which from now on it's going to show 2 digits below 0, below decimal point, right? And I want, for your exam purpose, 5 digits below 0, so that you will round up at the fourth digit, right, below 0. Okay, so how do we do that? Well, again, second, and then format, and then 5, yes, 5, and then enter, yes, and then naturally, automatically it gives you this. All right, so that's how we set up everything, and then from now on that will be it. Okay, good.